IFRS 9 Scope of Financial Instruments. Welcome to Lecture 3 of the IFRS 9 crash course. In this lecture, we'll examine the scope of IFRS 9. In other words, which financial instruments are covered by this standard and which are excluded. IFRS 9 applies to a broad range of financial assets and liabilities. These include loans and advances, both retail and corporate, mortgages, government and corporate bonds, trade receivables, lease receivables, and off-balance sheet exposures such as loan commitments and financial guarantees. All of these require expected credit loss calculations. Some items, however, fall outside the scope of IFRS 9. Insurance contracts are covered under IFRS 17. An entity's own equity instruments are governed by IAS 32. Certain embedded derivatives may also be separated and treated under specific IFRS 9 derivative rules. Why is this important? Because institutions must apply ECL to every in-scope instrument, even for undrawn commitments and guarantees. For trade receivables and lease receivables, IFRS 9 allows a simplified approach where lifetime expected losses are recognized without staging. Here's a practical example. A bank's portfolio might include a £500,000 corporate loan, in scope, a £2 million government bond, in scope, and a £50,000 letter of credit, also in scope. However, an insurance policy would not fall under IFRS 9 as it is governed by IFRS 17. To summarize, IFRS 9 has a wide reach, applying to most credit exposures on and off the balance sheet. Correctly identifying scope is the first step toward applying staging rules and calculating ECL. In the next lecture, we'll explore the forward-looking expected credit loss model and see how it differs from the old incurred loss approach under IAS 39.